I'll be asking Justin some questions at the end, which have been posed by you and also by some of the Cullen Wealth employees on your behalf. But before I hand over, given this is our 4th webinar and each of the previous have followed a particular trend, I just wanted to spend a couple of minutes prior to Justin's presentation just to add some comments on behalf of Cullen Wealth. As most of you know, when we make our recommendations as independent advisors, we make those recommendations having undertaken a detailed and thorough analysis of all the options that exist out there in the UK financial services marketplace. The advice we give to you is bespoke to you, for your circumstances, your objectives, and really one of our ambitions is to try and ensure that we put your money in the right hands. What do I mean by that? Well, here we look to recommend companies to you that we think are reliable, safe, value for money. Typically, these companies are those that are very well established, proven track records. They have considerable expertise and resource. Over the long term, they have displayed strong performance, effective risk management, competitive costs, and those we believe are amongst the most reliable and safe out there for you. In Legal & General, we think we've got one of those companies, and we now have a strong and long relationship with Justin and his team. There are, however, other companies we recommend. I'm conscious that at our 4th webinar today, this is the 4th time that Justin has presented. The reason for that is quite simple. We believe Justin presents very well, very engagingly in a language that we think our clients understand. We think at the moment, given the uncertainty that exists, it's very important to get some of the best presenters and commentators possible so you as our clients can get the best and clearest understanding. But it's important to say that most of our client portfolios do have other fund managers and ranges. This blend helps you to enjoy considerable global diversification. You have a variance of views from different fund managers, different investment styles, different stock selection. This, we believe, I think, is critical for a client portfolio, so you aren't vulnerable to one particular manager or style, and it gives you that extra dimension, particularly at the moment. I think that's so important. If you think that with Legal & General, there's several thousand individual stocks that exist in the Legal & General range alone that span over 100 different countries. Multiply that by more than one Legal & General, your portfolios are very diverse with very safe businesses. If there's more you want to ask me or indeed your Cullen Wealth consultant about the portfolio you've got, then please do so anytime. You are welcome to come direct to me. But I'm going to stop waffling on now, and I'm going to hand over to Justin, who's going to give us today's update. And then at the end, I'll ask you some questions. I think this time, Justin, you should be able to share your screen today.
Okay, let me give that a go. Hey, Stuart, can you hear me?
I can hear you loud and clear.
Right, let me try and give this a go.
If not, I can share mine, so no stress.
I think I should be okay if I do this.
Looks good.
Looks good?
Yes, I can see that. Thank you.
Brilliant, brilliant. Let me just get back into Teams, which is here. Okay. Excellent. We're good?
We're good, thank you.
Okay, brilliant. So we are in sort of uncertain times. We've got inflation at all-time highs, going back for 40 years. All the talk is, when will the recession, an imminent recession, when will that occur? So I thought today what I would try and do is to talk a little bit about recession and how that could, or whether it will occur first and foremost, and then ultimately what could be the key drivers that make that recession either very shallow or make it worse. My name is Justin Nukasi, as Stuart mentioned. I am the head of retail investments here at Legal and General Investment Management. LGIM, as we are known as an acronym, is the largest UK-based asset manager that's out there, and the multi-asset, multi-index strategies are the flagship strategies into retail space. So, moving on. What are we seeing in markets at the moment? So firstly, what you are seeing, if you look at 1 and 2, you're seeing this huge amount of inflation. So the largest inflation that we've ever seen, or that we've seen in the last 40 years, so since 1981, essentially, across the 3 key areas. You've seen today that the UK inflation now is at 9.4, US is at 9.1, I think, and then EU around 9.1 as well. And what we try to do on this slide is separate the long-term drivers from the short-term inflationary catalysts. But I think in summary, we can summarize, we've got 6 bullet points there. I think we can summarize really 3 things that have driven inflation over the last 18 months. The first one is the reopening of economies. And because you've had this staggered reopening and certain countries opening before others, it's meant that producers of goods, producers of machinery, they haven't been able to open all together at the same time. So you've had demand from certain countries pulling up prices because there's a lack of supply of lots and lots of goods and services. In particular, one of the examples is chips in cars and computers. They're only really kind of manufactured in certain countries in the world, and as those countries haven't reopened as quickly enough, what that's meant is the countries that have reopened have demanded those chips, and the countries that were still locked in lockdown haven't been able to supply them. So that's caused a huge amount of inflationary pressure. So if you ask businesses today, businesses are ready for the have extreme stress in terms of getting goods at the right price, and we haven't seen this stress, if you look at the kind of the business surveys, since the 1970s. The same is true of labor. So businesses are struggling to get the right people in the right seats, and of course that then has an impact on wages. Brexit has a big driver here, a big input into this relative to the EU and relative to the US. So that the troubles in the UK of businesses trying to get the right bums on seats, getting the people into the right jobs, has been a lot harder. The second thing, which I think has driven this inflation dynamic, and this is more of a short-term one, is the commodity situation that we're seeing right across the world, which has primarily been driven by the war we're seeing in Eastern Europe. If you think about the producers of commodities, whether it's agricultural commodities, whether it's precious metals, so gold, silver, platinum, whether it's industrial metals like copper and zinc, whether it's energy, so gas, oil, etc. Russia is a key producer in almost every single commodity in the world. So clearly when you shut Russia off from the rest of the world, that will lead to increased price because you're shutting off that supply of commodities into in particular Europe. So that's the second thing that's driven inflation. The third thing that's driven inflation then has been the policies that we've seen from central banks and governments. So central banks have effectively printed money. Why did they print money? Well, they printed money in 2020 to try and get us through the pandemic and to try and stop a deep recession during the pandemic. And that did help. it did help for us to avoid a deep recession. But on top of that, we also saw huge amounts of stimulus from governments to stop businesses from going bankrupt, right? We saw the furlough scheme in the UK. In the US, effectively the government wrote, or the federal government wrote checks for people in the post. So much so it made sense for them to stay. They were getting paid more during the pandemic than they were when they were working, and they actually were staying at home. So you had a huge amount of stimulus put into the economies, and what this has done is created this huge demand dynamic where the demand has been actually greater than would have otherwise have been. It's also created a huge amount of savings, and I'll come on to this a bit later on because this is really important as we think about recession. What is one thing that could stop the recession from being deep? It is huge amounts of savings that people have built up as they were given this money through either furlough or they were given this money through checks in the post. But what this inflationary dynamic has done is led to number three, is that central banks now, in order to maintain their credibility, if you think about the three key central banks in the world, or the three key central banks that are relevant for us in these portfolios, is the Federal Reserve in the US, the European Central Bank, and the Bank of England. So now each of those central banks typically have an inflation mandate, right? So typically their goal is to keep inflation typically to around 2%. Inflation is now above 9%. So central banks have to act. In order to maintain their credibility in managing inflation, they have to act. And that's exactly what you're seeing right now. You're seeing a forced reaction from central banks to increase rates in order to try and tame that inflation dynamic. Now, one big question at the moment is, well, does raising rates actually have any impact on commodity prices? Well, actually, it probably doesn't. But what it does do, it does have an impact on the amount that we can spend as consumers, which ultimately means there's less demand for commodities, and eventually the commodity price will fall on the back of that. But what this forced policy response does, it forces us to spend less, which then creates greater unemployment, which could push the economy overall into recession. So, there is this big question, is, are central banks doing the right thing here by raising rates and effectively pushing the global economy, whether it's the US, Europe, or the UK, into recession overall? So the big question is, can central banks increase rates and avoid a recession? Well, what we've done here is we've looked at every single rate hiking episode by the Federal Reserve, the US Central Bank, since the 1960s. So you can see here, you got the starts, so that you look at the columns, you got the rate hiking episode, the start of the rate hiking episode, and the end, what the change was in the interest rate, and then whether you saw a recession or a soft landing. And then later on, we've got different economic conditions, and the flags just mean whether, was unemployment really low? Was inflation really high? Was inflation expectations really high? Was debt really high? And was energy really high? So those flags are just trying to give you a feel of what the economic conditions were at any particular point in time. So what's really important here is when you look through, there's 12 observations here since the 1960s where the US Central Bank has been raising rates. Why do we use the US Central Bank here? Because the US economy is the largest economy in the world, and it's very rare that the US can go into recession and the rest of the world doesn't go into recession. It's really important. So what you can see is, of these 12 observations here, that 3 of those observations, central banks, or the US Central Bank, has been able to raise rates without there being a recession. So soft landing means they avoided a recession. However, in the other observations, you see, quite clearly, the other 8 observations, you see quite clearly that it led to recession overall. So what do we think about this situation? So you see right at the bottom of that chart, this table, you see March 2022. This was the start of the rate hiking episodes in the US. Do we think there's going to be a soft landing, or do we think there's going to be a recession? We think it's going to be very difficult for the central banks to avoid a hard landing here, so avoid a recession. Why? Because unemployment is really, really low. So, you know, the likelihood of that raising rates is going to start to lead to an increase in employment is greater. And then also inflation is really high. So it means that the brakes are going to have to come on pretty hard, and we're going to see a significant increase in that Fed in the interest rate in the interest rate hike. So overall, we think it's going to be very difficult for the US central bank to avoid a recession. However, there are certain things to take into consideration. So these are talking points of what's moving the dial at the moment. So cost of living crisis. I'm going to talk a little bit about why that cost of living crisis, what it could mean in terms of overall recession, and linking it back to those increased savings that we've seen from the consumer over time. So it's not all bleak, it's not all negative. Defensive portfolios. There are a number of clients that I know that are in defensive portfolios, which are made up a lot of bonds. One of the big questions that the clients have been asking us is, are these portfolios still defensive? We've seen big falls in those defensive portfolios year to date. What can we do going forward to keep those portfolios in a defensive mindset? I'll come on to talk a little bit about that. Inflation, energy prices. I do think one glimmer of hope that we're seeing in the inflation dynamic at the moment is that energy prices are starting to weaken. We're starting to see the commodity increase stop and start to fall away, and that should lead to a better dynamic going forward. And of course, I will talk about UK politics and what we're seeing from a political sphere at the moment, and what impact that could have on your portfolios, most importantly. So, firstly, that inflation dynamic. There is a very strong case here that if inflation starts to settle, central banks will not have to increase rates as much, and therefore we could avoid that hard landing that I mentioned. And we are seeing alleviation here, right? So firstly, on supply chains, one of the big challenges that we've seen is whilst the US, the UK, and Europe have effectively reopened, China, a big producer into those three regions, have had these mini lockdowns and haven't really reopened properly. However, we are seeing now that China has started to reopen a lot more, and those goods that China produces are starting to be passed on to the Europe, to the UK, to the US. So importantly, that supply constraint is starting to go away, and as China reopens, there are more goods being put onto the market. So companies were expecting in the next 6 months to start to say, well, actually we can get hold of goods now, and therefore we don't need to pay this extreme price to get hold of them anymore. In addition, shipping costs are starting to come down. You know, as we're starting to see things reopen more, shipping costs are starting to come down. And I mentioned about chips, or also called semiconductors, which are in our computers, in our cars. Again, we're starting to see the prices of them come down. So really, really positive in the graph there, that the prices that we're starting to see from the supply constraints are starting to ease. I mentioned commodities, and in particular, oil and gas prices are starting to fall off recent highs. Food prices are starting to come down, but we are seeing consumer demand start to slow, which is obviously a negative. But what that does do, as consumer demand slows, it does mean that the prices of commodities have started to come off. And you can see here, we've got industrial commodities here. So, you know, your metals, your zincs, your coppers, your aluminiums, they started to fall more recently as well. And then finally, inflation expectations. And this is really important. This is what central banks really look at. They don't really look at the headline inflation rates. What they look at is where they think people think inflation is going to be in 1, 2, 3, 5 years' time. Why is that so important? Because if we think that inflation is going to fall back to low levels, we won't go into the office and demand high wages. We won't be, we're willing to hold off purchases because we think inflation is going to come down. And that mindset has a real important part to play when we think about the global economy overall. So long-term inflation expectations actually remain pretty low. So even though inflation is up at 9.4%, actually inflation expectations, this looks at the US. So this looks at this chart here looks at 5-year inflation, what people think inflation is going to be in 5 years' time. And actually, they think it's going to be around 2%, which is the target for central banks. So these are 3 key things which makes us think this recession may not be as deep as it could be. And actually, we may be able to avoid it if inflation starts to come down to more normal levels. Another positive is the cost of living crisis. I was going to say the positive is the cost of living crisis, but obviously the cost of living crisis isn't a positive. It's a huge negative. However, when you look at consumer balance sheets, so I say consumer balance sheets, but what we have in the bank, what you see is that the amount of savings that the individual has been able to accrue since 2020 has been quite large. So although there's been some spending, because we've been given these overall, people have been given these checks in the post. They've been worried about the economy overall. They haven't been able to go out to go on holiday and so on and so forth. It means that their balance sheets, that our bank accounts are actually in decent shape overall when you look at the whole of the global economy. So here we look at the UK, we look at Japan, Australia, and the top 4 European countries, and the US, and you can see really across the board that you are seeing really quite healthy bank account balances for the regular man and woman on the street, which should mean that even if there is a recession, that people can dip into their savings, and therefore the recession actually could be quite shallow. It's probably worth talking a little bit about defensive portfolios. I do think this is something that is really, really important. We look at the returns of defensive portfolios year to date, and some of those defensive portfolios haven't been defensive. Let's put our hands up, right? So you're talking probably sometimes 6%. It could be even 7% falls with some of those defensive portfolios. Why has this occurred? Because bonds that typically protect on the downside have had their worst performance in the last 30 years. In fact, on record. So this looks at this chart looks at the Bloomberg Global Bond Index. So it looks at essentially all the bonds in the world and looks at what they've returned overall. And it looks at it on a half-year basis, so every 6 months. So what you can see is since 1991, when the data started to be collected, you can see pretty much over that period, the falls that you've seen have been very minimal. You saw a significant fall in 1995, and then pretty much you haven't seen another fall since then until 2022. So I think it's really important to put bond performance into context and say that actually bonds have effectively done their job since 1990, apart from two periods, in 1995 and unfortunately 2022. So one of the big questions is, are bonds still defensive? Well, basically if you just took a crude look at this chart, you would say, well, these 2 points are anomalies. And actually in almost every single period, other than these, well, you've never seen falls bigger than 5% apart from these 2 periods. So I think we can take some comfort that going forward, we will not see these huge extremes in the bond market. But also, whenever an asset class has an extreme level of underperformance, history tells us that typically they don't have that level of underperformance in future periods. The other thing I would add is that as bonds have fallen, actually now they look a lot cheaper. So within a portfolio, they're actually looking a lot more attractive than they have done historically. One other thing to add is that when you think about those defensive portfolios, the bond element is simply one element of that. And what you saw in the first half of 2022 was not only that bonds fell, but everything else fell as well. Typically, when bonds do have those negative falls, you get positive returns in the other areas. And when equities in particular, or shares, companies fall, bonds typically go up in value. But you didn't see that, you haven't seen that in the first half of this year. However, over the last month or so, that relationship has started to come back as you've seen falls in equities, falls in companies, bonds have started to provide protection again. The last thing to add on this, and I think it's really, really important, is if you are going into a recession, what is the one asset class you want to have in your portfolios? It's bonds. Bonds typically perform better than any other asset class when you are entering or maybe entering a recession. So with the level of uncertainty out there, our view is that for those defensive portfolios, it makes sense to continue to hold onto your bonds. And actually going forward, you're unlikely to see such extreme performance in those defensive portfolios. One last thing to add is that since 2013 and the launch of multi-index, those defensive portfolios have delivered a return of close to 5% per annum. That's exceeding expectations. So over the last 9 years, in 8 out of 9 of those years, bonds have done better than you would have expected. So anybody that's been in defensive portfolios for that long has seen the benefit of holding bonds. So it's really important not to throw the baby out with the bathwater after 1 6-month performance that's negative and think, okay, bonds are not going to provide protection in my portfolios going forward. Really, really important. The last thing I want to talk about is the UK, is the politics. So here we simply show an opinion poll from I think it's actually from YouGov, but we pulled it from the images from Wikipedia, which shows essentially over the last 2 years, where different parties have been scoring, and you can clearly see that, since Partygate was really really started to bite, that the Conservatives started to lose popularity in the opinion polls, and you started to see growth in the opinion polls of Labour, but also importantly, really importantly actually, the Liberal Democrats. Why are the Liberal Democrats so important? Because effectively the Liberal Democrats are often in play in Tory seats or Conservative seats, and therefore, even if the Liberal Democrats win, a few seats from the Conservatives in typical Conservative areas, then it tends to mean the probability of Labour getting in is a lot greater. Clearly, there's lots of uncertainty around the UK political situation, and we're currently looking for this for a new prime minister. How are markets reacting? Well, I think there's really two areas where you can see a transition, or you can see volatility in markets, and the market's changing based on the way the politics are going at the moment. The first one is via pound sterling. Pound sterling has been pretty weak year to date. However, it's really important to establish, is that pound being weak, or is that other currencies being strong, in particular the dollar? The dollar's been very strong this year. But I think you're going to continue to see volatility in the pound as this political, as the politics, until we get some political certainty. I don't think you're going to get any political certainty even when the Conservatives elect their leader, because then there's a big, I think it's going to be a big clamour for a general election, because you're going to have an unelected leader in charge of the country, which never goes down very well when you look at politics across the world. And then through the UK government bond market, you may see some weakness here, and you are seeing volatility. But the weakness that you'd see would be that if you got a prime minister in who has spoken about spending significantly, that could have an impact on, because they're going to have to borrow the money, which will mean that bonds will typically sell off, because the more debt you have, the more at risk you are as a government. But with Sunak, kind of being the favourite here, we know that he is very prudent with the, or what was prudent as Chancellor, and therefore you have seen some stability in government bonds on the back of that. But what I would say is that, as I say, this uncertainty is going to continue even when the Conservatives have picked their leader, because of this clamour that there's going to be for a general election, but also that eventually you will have a general election, and unless the opinion polls turn around, then we go into a situation, a general election, where there's going to be uncertainty around who's going to win. And typically with a Labour government, sterling tends to be weaker and government bonds tend to be weaker, typically. So that's the view on the politics. And then my last slide, I'm finishing a little bit early, but my last slide is a slide which I think is really, really important. Our overall view is that there is between a 60 and 65% chance of recession. We think the recession is likely to be shallow, but it's really important to note there's a 40% to 35% chance, even in our view, that there won't be a recession. That's quite a high probability. Markets are already pricing in a recession. So if you think about what markets are pricing in, they're typically pricing in a recession now. Okay, if there was a recession, then they might sell off a little bit more. But there's no guarantee of that. So this chart, I think, is really, really quite important. No matter if you are expecting growth, you're expecting recession, it really doesn't matter. It's really hard to time the markets. So anybody thinking of taking their money out and putting it under the mattress, I don't think makes a lot of sense. It's not about time in the markets. It's about time in the markets. And hopefully this chart, which I've shown before, really helps to articulate that. So what the light blue line shows is the the dark blue line shows the FTSE All Share from 1985 to date. The light blue line shows the FTSE All Share if you missed the top 10 days. We missed the top 10 days. So if you assume that you invested £100,000 at the end of 1985, being in the markets would have generated you a return of £2.1 million. But just missing those top 10 days would have led to your portfolio being down by £1 million. So just missing 10 days would have had a £1 million impact on your portfolio overall. This is why it's important to remain in the markets. And actually, the most volatile times, both up and down, tend to be as the market starts to think about a recession. So really, really think that being in the markets is really important, and staying in for the long term is really important. Volatility is part of investing, and if you don't take that risk, you will not get the return. And that is the end of my thoughts. I think the clear thing is, recession may come. There's actually quite a sizable probability that it doesn't come. However, our overall views is we think recession is going to be shallow, and it makes sense to remain in the markets even throughout the volatility. My name is Justin Nukasi. I'm the head of retail investments, as I mentioned at the beginning. Now I'll pass back to Stuart for questions.
Justin, that was an excellent presentation. Thank you very much indeed. Yeah, if time permits, I've got a couple of questions to pose. I guess just, one of my observations listening to you there is that, I've heard a bit of a mixed message about bonds. On the one hand, I've heard this relationship between bonds and equities is re-establishing itself after the first 6 months of the year where they both fell. But then we've got the political uncertainty coming up, which may cause further uncertainty in the bond market. So a lot of our clients are naturally quite concerned about the behaviour of what we describe as fixed income investments, right, which are the bond markets generally. So, how do you see that particular type of investment behaving over the next 12 months or so?
Yeah, so you are right. There was a mixed message there in that you are starting to see this relationship come back, yet at the same time, UK government bonds may be a riskier proposition than they have been historically, given the political turmoil, let's call it, that we're seeing at the moment. From a portfolio perspective, one of the things that we are trying to do on the back of this is simply spread the risk outside of purely the UK market, move into the US, move into European bonds, New Zealand, Australia, Korea, spread that risk across different developed markets, because ultimately you don't want to be at risk of one particular country's political environment. Spread the risk all over those different countries, and therefore you should get greater protection overall from doing that. My overall feeling, I don't really like to give kind of forecasts on or point forecasts on asset classes, But when I look back in history, and whenever you see extremes like this, you even saw it on the graph there on the table I showed, right? You saw in 1995, you saw the extreme, and then effectively you saw another 10 6-month periods of positive returns, right? So my overall feeling is that when you see extremes in markets, then actually over the next few periods, actually tends to get a big bounce back, and I think we are starting to see evidence of that in the bond market. And then the other thing is this recession element. If we do get that recession, you want to have bonds in your portfolio, right? And you probably want to have as much as possible. So that's quite a big dynamic. And then the last thing that you're seeing is the inflation number is starting to tick down. The reason why you saw this increased behavior between bonds and everything else all moving in the same direction was because of that inflation dynamic. So if that starts to settle, then actually bonds should be back in favor and actually will play a key part in portfolios.
Thanks, Justin. And I wanted to say to everyone here today, if you've got any specific questions or concerns about bonds, particularly, which I know have been a particular problem for investors over the last few months, then do raise them with us, and I can ask Justin to answer those questions as best he can. So just some other questions. An interesting one from a client here. As a relatively new investor, how do I decide where best to make investments during such difficult and unpredictable trading conditions? Now, of course, you're going to tell them to invest into the Legal and General multi-index range, but if they were a self-investor, how would you help them?
Yeah, it's a really good question. I think we have actually a huge challenge with people who are investing for the first time, and part of it is a perception of what investment actually is. People think that investment is about trading and getting like massive returns in a short period of time. That isn't investing to me, that's gambling. Investing to me is putting your money in something that's relatively diversified over time, spreading your risk over lots and lots of different asset classes, and trying to generate returns in a smooth way over time. So as an investor or as a fund manager, what I don't like returns like this. What I want is kind of smooth returns going up over time. And I think investing in a multi-asset portfolio gives you that. It gives you that diversification. I think, testament probably to when I look at your proposition, a number of different multi-asset funds means you're getting that spread and that diversification in the Cullen's proposition. And also, really importantly, I put my money where my mouth is, that's the way I invest. I invest that way. And the key thing when you invest that way is not to, over the last few years, you've seen some really big numbers from companies like Peloton, like Tesla, and so on and so forth. And a lot of individual investors have gone into these pretty much with their eyes closed, and they've been severely burnt, chasing tech stocks up and up and up. So, relative to some of the horror stories that are out there, multi-asset funds have done a pretty decent job this year, but also going back over the last 9 years.
Thank you. And I also invest into multi-asset funds personally, so I also follow your strategy. Another interesting question here: if we do enter a recession, how will you change your views and management of the funds?
Yeah, it's a really good question. So, the way we think about the world is we think about it on a +3 or -3 scale. So +3 is when we want to be most positive, -3 we want to be most negative. Currently we're at +0.5, and you might think that's really strange, like you're above 0, so you're taking more risk than average. Part of that is this inflation dynamic, and it's that companies, so being positive on risk overall from a portfolio perspective now means we've got a slight, we're taking more equity risk, we're taking more risk in companies than we would have, or shares than we would have on average. Why are we doing that? Because what you're seeing right now is that companies are passing on the inflation costs to consumers. So you're not actually seeing any significant hits in company profitability. So therefore, as an inflation hedge, we're taking those or almost get inflation protection, we're taking more exposure into those companies. However, if we get closer to a recessionary dynamic, where we'd really want to be is at -3 on that scale. So most negative in terms of risk, and really have the lowest amount of companies in our portfolios than we ever have since 2013. So less shares, more bonds. That's effectively the way you'd want to position. Oh, and probably some kind of more cash in the portfolios as well.
Thank you. You're all right for time for a couple more minutes, Justin?
Yeah.
So do tell me if. I've got more questions. So if the Russia-Ukraine situation continues and develops further, how do you see that affecting inflation, economies, the markets, and how will you manage that as best you feel you can?
Yeah. Okay. So there are a few elements which I think are really important in this Russia-Ukraine dynamic. It doesn't look like it's de-escalating anytime soon. I think going forward, we're going to see greater military spend. I think there's no doubt about that. You think about what NATO had been spending on military, and almost every country were below their targets in what they were supposed to spend. I think we're going to see a reversal of that, and you will see greater spend on military. I think overall, there's an argument you will see a movement towards deglobalization. So the world is going to become less interconnected, given that countries have felt their national security was put at risk by being connected to a country that they have since found out that when they put sanctions on them, it hurts them. I think from a global geopolitical perspective, you've got a significant power in China, who are probably looking at this situation and thinking that, well, look how easy it was for the West to put sanctions on Russia. We are relying on the dollar as a funding currency almost to keep the banking system alive. I think there's going to be an argument from a Chinese perspective that they want a different currency, that's their reserve currency, that keeps the banking system alive. And then finally on inflation, I actually think that inflation's a strange one, right? Because even if energy prices remain at elevated highs, just as though they don't go higher and higher and higher, then actually the inflation, it will fall out the inflation numbers, right? Because if inflation's at 100, if oil's at $100 today and it's at $100 in 3 years' time, that the inflation of that oil is zero, right? So we've already had the big jump. So actually, I would say that inflation from here, unless this really escalates further and you see greater supply constraints for other countries supplying oil into the West, I actually think inflation will start to come off. And you've already seen Biden when he went to Saudi Arabia. Saudi Arabia have come with a commitment that they're going to start pumping more oil, right? So actually, I think, you know, unless you get significant supply constraints from here, inflation shouldn't keep on going up in a straight line.
Thank you, Justin. I'm going to call it there. I think there's one or two other questions, but I think in the round you've kind of answered them. So I think we'll probably just end up repeating ourselves somewhat. So I want to thank you very much for another very engaging and compelling presentation today. You are making my life difficult because I can't find anybody else as good as you to do this. So I'll keep having to ask you to come back and do it. So if you're happy to, that's great. And thank you to everyone for attending today and for the questions and support. Feedback is always welcome. Everyone has my contact details, so do please, if there's things you want us to cover, things you want us to help with, then do come to me or your usual Cullen Wealth consultant, and we will be delighted to help. So I'm going to call it there and say bye, and thank you very much, everybody. Justin, thank you. Bye-bye.
Thank you, Stuart. Thanks, everybody.
Bye. Bye.
Take care.